We are at that point where if a large consumer of silver, especially, someone on the industrial side that absolutely needs the silver, holds, let's say, a long contract, a futures contract, and stands for delivery, and then they're told, sorry, we just don't have the silver to deliver. We are going to hear about that, and so they need the silver. They don't need the cash, because if they can't turn around and use the cash to go out and buy the silver somewhere else, with supplies being that tight.
I was saying there's no way that gold makes a major move, a major breakout, and silver just gets left completely behind. It may not perform as it has in the past. It may underperform, but there's no way it just gets completely left behind. So the broader answer to your question is, if I'm expecting a period of consolidation for gold and then the next big move to be upwards, then I would expect the same for silver.
The global silver market has reached a critical tipping point as industrial demand outstrips available supply, creating a high-stakes environment for physical delivery. We are now at a point where major industrial consumers standing for delivery on futures contracts may soon be told there simply isn't enough metal to fulfill them. This structural deficit means that for those who absolutely need the physical metal, cash is no longer an adequate substitute. As supplies tighten and the paper market faces a potential reckoning, the urgency to secure tangible assets has never been more apparent. Joining us today are market experts PeterKrauth and LoboTiggre, who dive deep into the mechanics of this supply squeeze. Krauth and Tiggre discuss the reality of the silver market, moving past speculation to look at the objective industrial needs that are driving this historic tightrope walk. They analyze how a lack of physical metal could trigger a major shift in how gold and silver are valued compared to cash, especially as global forces continue to debase fiat currencies. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think that we got a pretty big correction right after that huge run-up late January, where it went to about $120 intraday. And at the time, I was at a mining conference, and I was asked the same question, and I said, this is too much too fast, and we should expect a correction. And I was kind of hoping for one, frankly, because I felt it needed to reset and digest some of those gains, and that it was not sustainable. So if you had looked at what silver has done in prior bull markets and the kinds of corrections it's gone through, but this 2001 to 2011 bull market, it had 5 corrections of 14% or more, and those corrections averaged about 30%. So the worst one was almost, I think it was close to 40%. So we got that within a few days after that, actually. So very late January, early February, it started to correct and went intraday from 120 or so intraday. A few days later, it was at 67 and has bounced, and it's been over 90. We saw that in February, and then early or mid-March, it started to correct again. And we've sort of seen this second wave of the correction, brought us down below 70 again. And as you said, in the last few days, we're back up. I do think, I have a sense that we may have seen the worst of it. I'm not sure that the correction is done. So I think that we could continue to see some volatility and some general sideways movement in the price, perhaps for another month or even a couple of months. That's typically what it takes in terms of time-wise for these corrections to play out after big run-ups. But I think that on balance, we're definitely going to trend higher. So in my view, it's looking pretty positive nonetheless. And I think the move of the last few days is quite encouraging. I pointed out already a couple of years ago that I thought that what had, at least in part, kept a cap on the silver price was that big consumers of silver, industrial consumers essentially, were able to go out and buy silver on exchanges that was already produced, that was just sitting there in stockpiles, and they could go out and buy this silver at the prevailing price, which was in a $20 to $30 range, and just buy all they needed. There were a few billion ounces of capacity, secondary inventories just sitting there, and that put no pressure on bringing new silver to the market, either from mining or recycling. But that was a steady draining of those inventories. And I said once that has pretty much run its course, which I felt was about 12 to 18 months, that it was game over, and that the market would have to come to terms with the fact that it had drained those inventories, and that we were not going to see new meaningful supply come to market. And that's essentially what happened. I was talking about that in early 24, and then by the middle of last year, it really started to move. We had that 18 months or 15 months or so, and then you had, by the time the 18 months or so were there, we were by the end of last year. And I still think that supplies are extremely tight. Last year in the World Silver Survey, the Silver Institute said that they not only have we been through 5 years of structural deficit, but they saw the next 5 years would also bring structural deficit. And not only that, but new record deficit levels. And it's interesting, if you look at their numbers, they show silver that goes into silver ETFs as a separate line item for demand. Physical silver demand is included in overall demand, but silver to ETFs is a separate line item. And their reasoning is because, well, that silver is not consumed, and it can easily be sold if people sell their ETF holdings, and that silver becomes available again. My argument is that that's true for physical coins and bars as well. Perhaps people are more attached to them if they actually buy the physical, but it doesn't mean that they can't just turn around and sell that back to the market. So interestingly, if you include their projections for overall deficit, including silver that goes to silver ETFs, then their projection, we're going to get final numbers probably later this month, actually, in a couple of weeks when their next survey comes out. But that last year's overall deficit is probably going to be a record deficit, including silver flowing to ETFs, at least over the last 10 years, and a notably high record. So we are at that point where, if a large consumer of silver, especially, someone on the industrial side that absolutely needs the silver, holds, let's say, a long contract, a futures contract, and stands for delivery, and then they're told, sorry, we just don't have the silver to deliver. We are going to hear about that. And so they need the silver. They don't need the cash, because if they can't turn around and use the cash to go out and buy the silver somewhere else, with supplies being that tight, then that'll be a serious problem, and that could really blow the top off this thing. And so that's certainly something. I mean, it's hard to put odds on something like that, but I think that we're sort of gradually moving more and more towards that kind of situation where the risk is moving up towards that. We're not bringing meaningful new mine supply. Recycling has not really changed that much. That could in the next year or two, especially if we stay at more elevated levels. But frankly, recycling represents about 15% of the silver supply every year. You'd need a really meaningful move in recycling for it to be an overall notable new amount of supply to the market. So I expect supply may grow slightly, 1% or 2% per year. It's still below what we consume every year by at least probably 10 to 15%. So there's a big gap.
Silver has officially transitioned from a speculative trade to a critical industrial necessity as we enter the second quarter of 2026. While prices have stabilized near a new structural floor of $70 following the dramatic surge to $121 in January, the underlying urgency is driven by a staggering sixth consecutive year of global supply deficits. With industrial demand from AI infrastructure, 5G expansion, and electric vehicles now accounting for over 60% of total consumption, the market is facing a physical cliff, where above-ground inventories are being drained at an unsustainable pace. This isn't just a price story, it is a fundamental reset where the world is realizing that physical silver cannot be printed or easily replaced. The experts in this discussion analyze this unprecedented supply squeeze, highlighting why the traditional paper markets are becoming increasingly disconnected from physical reality. They explain that major industrial consumers are now facing the very real threat of being unable to source the metal they need for production, regardless of the cash they offer. The conversation focuses on the fact that silver is no longer just poor man's gold, but a high-tech strategic asset that is currently being repriced in real time. By examining the massive rotation out of declining currencies and into tangible reserves, they reveal why the current consolidation phase may be the last chance to secure physical metal before the next supply shock. Let's get back to the interview.
I saw a headline on mining.com, which you would think would be mining friendly, talking about this biggest drawdown in gold's history. So yeah, but after it went fucking vertical, pardon my French, after it went vertical, okay, so you have a correction. Well, what do you expect in that correction? And it just so happens, February 28th, things worked out for a monthly coincidence. If you look at the year chart, gold has not just had a great year in 25, but, it's still in that hockey stick mode. We had a big correction. So if I could rewrite that headline, I would say gold rebounds and is back, closer to 5,000 to 4,000, which is when people were really worried. And sorry for the bit of the rant, but I think this is important. Have some perspective. Our good friend Ronnie Stifferle, or however you pronounce that, from In Gold We Trust, he just posted a great meme with this person with gold hits 4,500. He's like, yay! And then gold hits 4,500, and the other side he's like, boo. Right? It's the same level. Perspective matters so much. But, take a step back, have a deep breath. Look at, $4,500 gold. Actually, I don't remember the last time we did an interview, but it was a while ago, before the big correction. And if we talked about it, I was saying at the time, and we might have said this together, that, gold's over 5,000, 5,500. Gold could drop $1,000 an ounce, and it would still be a phenomenal level for the actual business of mining this stuff, right? 4,500, these mines were built for sub $2,000 gold, and silver even more leverage. So that's the context here. Sorry, I really am going on this rant, aren't I? I didn't plan this, but I just want the audience, and I'm not saying gold's got to go to the moon. I'm not a permabull. They call me Darth names and stuff like that because I'm not a permabull. But I think anybody that's panicking or thinking the party's over, have some perspective, take a breath, look at it. 4,500, well, actually we're closer to 46, 47 this morning, another plus $100 day. This is not a bad level, and the miners are doing great. So this brings me finally to answering your question. I actually did buy a gold copper stock recently that I thought was oversold. So even in this market, and I'm Mr. Buy Low, Sell High. I don't chase momentum. I seem to be genetically immune to FOMO. I just don't chase. When things go like this, my thought is not, oh, I need some of that. My thought is, oh, I missed that. So the fact that even I bought something recently tells you, to the very direct answer to your question, that volatility can be your friend. This is one of the fundamentals that Doug Casey taught me, when I was in diapers starting out in this business. Doug Casey taught me to make volatility my friend. And that's, I think, the takeaway from our current context. If I'm bullish on gold, I can't be bearish on silver. That's just the way it is. The gold-silver ratio can expand and contract. And I remember, after the 2020 surge and silver disappointed, a lot of people were saying, and even me with my Darth Silver mantle, I was pointing out silver's greater industrial side. And there was many times where it moved more like copper than it did like gold. But even at that time, I was saying there's no way that gold makes a major move, a major breakout, and silver just gets left completely behind. It may not perform as it has in the past. It may underperform, but there's no way it just gets completely left behind. So the broader answer to your question is, if I'm expecting a period of consolidation for gold and then the next big move to be upwards, then I would expect the same for silver. If you recall, a few minutes ago, I said monetary metals, not just gold. But silver is always more volatile. Like silver is gold volatility on steroids. That can be a good thing. If you have the discipline to make volatility your friend, I could see a scenario where, let's say we just wobble sideways this year, plus or minus 10% corrections. In the 2020 to 23 consolidation, gold varied almost as much as 20%. We've gotten close this time, right? So as silver does it again. So what I'm saying is, in this period, it might be easier to find opportunities to buy low in silver than in gold. Oh, sorry. One more thing. When we're talking about all this buying and selling, and people get mad at me, oh, you're a trader, you don't have conviction, you're selling too soon. I'm talking about the stocks, not the bullion. I save in bullion. It is my rainy day fund. It's that financial asset that you can be long for which there is no short. All that stuff has never changed. I don't trade. I don't speculate on gold and silver itself. Those are my savings. I'm talking about stocks, and buy low, sell high is the marching orders.
Silver is currently witnessing a historic industrial squeeze that is fundamentally altering the global supply chain as we head further into 2026. While headlines focus on short-term price volatility following the massive January peak, the real story is the staggering structural deficit that has now persisted for 6 consecutive years. Industrial giants in the EV and green energy sectors are no longer just monitoring prices. They are increasingly worried about physical availability. With above-ground inventories being drained at record speeds and mining production unable to keep pace, the market is shifting from a speculative playground into a high-stakes race for tangible delivery. This creates a unique window where the paper price may soon be forced to reconcile with the vanishing reality of physical stock. In this deep dive analysis, our guests explain why recent market corrections are a healthy part of a much larger, vertical bull run rather than a sign of weakness. They break down the critical difference between retail trading and institutional accumulation, highlighting that the smartest money is moving into silver not for a quick flip, but as a strategic necessity. By looking at the objective data behind mining drawdowns and the sheer volume of metal required for modern infrastructure, they reveal why the current consolidation phase is likely the calm before a much larger storm. We explore the mechanics of standing for delivery and what happens when the world's largest consumers find the vaults empty. Share your thoughts in the comment section below. If you found this market analysis valuable, please support the channel by liking this video and subscribing to more exclusive Precious Metals content. Don't forget to hit the notification bell to stay updated. Thanks for watching.